Good morning, guys. It is Friday, May 24th, 2024. This Bathrobe business. I'm Georgi Oganov. I'm getting messages and I got the coffee. Let me silence that. Okay. Uh, all right. So let's jump into that. So today, I don't have too much to report that's groundbreaking, but I think there's a lot of interesting stories in regards to inflation and what's coming. So I do want to talk about that in a minute. So the first thing I want to talk about, real quick, I'll mention this because it has been in the news. I didn't mention it throughout the week, but crypto is probably going to get an upgrade with Ethereum getting an ETF sometime in the near future. It hasn't been officially announced. It's just there's certain regulatory changes that have been changed at the SEC that would allow it to enter. This isn't a new story. It's a couple days old, but I thought I would throw it out there because it's now official. So there's that. Next story I want to talk about, Google. So I want to talk about Google because I often talk about this, and I feel like this story perfectly illustrates what I'm talking about. So oftentimes when interest rates are low, these big tech companies and big companies in general have a printing press. They get money lended to them for pennies on the dollar. And when you think they're getting it at the prime rate, it's usually probably below. So when they have these printing presses, they can just do whatever they want, and it crushes Main Street businesses because that's not how most businesses operate. Silicon Valley operates entirely off of valuations, investment, credit lines, etc. It's a financialized market. It's something that Main Street doesn't have. You, as a mom and pop organization, do not have that kind of luxury. But when interest rates are high, they don't. They have to actually operate lean and efficiently. And I think this story perfectly illustrates that. So this is a story from Bloomberg, and this is Google's Tech Innovation Lab. I think it's the Moonshot Lab. I've always heard it as the Innovation Lab is shutting down. So if you guys don't know what this is, Google's Innovation Lab was always a place where the Googlers could go to create new tech, play around. They had access to all of this technology, parts, etc., 3D printers, Raspberry Pi boards, etc., and they would experiment and create new products. And this was always pitched as, oh, this is the future, this is a techno utopia, etc. And this allows us to create new innovations and new products, essentially having startups in-house. That, to some extent, is true because one of the difficulties of a company maintaining its dominance in the market is its lack of innovation. If you read, what was the book? There's a book out there literally about this, about how startups often have an ability to innovate, and its name totally escapes me, and it's a famous book, but it's about how most businesses can't compete with startups when startups have a new technology that enters the field because they just don't have the ability to adapt to the market quickly enough, but a startup does. So the innovation lab theory is that they'll be able to have startups in-house development and then expand it to the greater line. But the fact that they're shutting it down means it's not profitable. And that's what I'm talking about. This is a company that now has to operate efficiently because it doesn't have a printing press anymore. It has to financially decide what is more important to it. And these innovations that they came out of the lab probably aren't, because 90% of the time people would just mess around, waste money, waste product, waste time, and now they can't do that anymore. And so this is why I love high interest rates, is because it makes the market operate more efficiently. And you're going to see better results from Google. You're going to see better operating income from Google. They're going to be laying off people that are not pulling their weight. And this is how you get an efficient economy. This is real capitalism. Now, I am never celebratory of anyone that loses their jobs, but if you're not doing a good job, you probably shouldn't have one. So that's one thing I want to illustrate, is the fact that this is another sign. I mean, all the layoffs are a sign that the market is getting more and more efficient. But this is, I think, one of the best signs of what's happening in the market, because these big tech companies are starting to operate in a way that they never have had to do in the past. Next story I want to talk about is going to be in regards to inflation. I know it's one of my favorite subjects, but I think some of these stories are very powerful well, let's start with the first one. So the Big Mac Index. So for those of you that don't know, there is such a thing as the Big Mac Index. And all essentially this is the cost of a Big Mac correlates better to inflation than CPI, PCI, et cetera, et cetera. So this is a story from Fox Business. Keeps wanting to start this stupid video. But this is a story from Fox Business that perfectly illustrates this. So the cost of a Big Mac pre-pandemic and post-pandemic. So the cost of a Big Mac went from $3.99 in 2019 to more than double, $8.29, according to the fast food price menu. So this is actually pretty stark because I don't think anyone operates as efficiently as fast food, especially McDonald's, right? I recently rewatched The Founder, such a good movie. This is a company that operates in a lean manufacturing kind of approach to food. So there's no company that can operate at low cost better than McDonald's. They've had a dollar menu for decades, right? There is no company that can do it better than McDonald's. And this perfectly illustrates the fact that the price of a Big Mac has gone up more than double. So despite what inflation rates may show, despite PMI, PCI, CPI, this is the real indicator of what people are paying at most stores and most restaurants. To have the cost of a Big Mac double, that could slice your income in half, because that means that food prices have doubled. And this trend continues overall. Subway, the $5 footlong, hasn't been around in a long time. The average cost of a footlong is now $8.49. Chipotle, they had burritos that cost $6.50. They are now up to $10.70. And it continues and continues. Now, this is old data, right? This isn't necessarily anything new, but I think it's very illustrative of the fact that costs are so high right now, even after everything. Remember, inflation is an acceleration, but at the end of it, you still have high prices. So this perfectly illustrates the fact that at the end of this beautiful rainbow, even if we got inflation to zero, that's the cost of acceleration. We still have an environment where prices are so much higher than they used to be. So there's that. Next story I want to talk about is the final story and the most important one. So this is going to be a story about shipping containers. So this is a fantastic article on CNBC. Give me 2 seconds just to bring this up. Okay, hopefully you guys can see this story. I'm still kind of wonky with this software, but let's see. So, and the link to these articles are all in the description below, of course. So, shipping container costs are soaring, and I would say that this is a signal of more inflation to come probably within the next 3 to 6 months. And this isn't a small story. So, over the last year, we have had many inflationary pressures on shipping, right? The Red Sea was the first one. The Baltimore crash was the second, and now we're facing a third one. So it's the sudden rise in container costs. So shipping containers, like everything else, have a certain cost, and their cost is skyrocketing. Now, there's other factors in this article I will mention, but I first want to mention the shipping container cost. So with shipping containers, the cost of many of these things are skyrocketing. For one, because of the diversion from the Red Sea, a lot of these container shipments are using larger containers to make larger distances. They're not going with the smaller ones because they're not docking at as many ports. So they have to go from shorter containers to 40-foot containers. That is causing a deficit in the containers, and their price is starting to surge. So the average cost of a shipping container was about $3,000 to $5,000. But now it's actually, so here it is. The cost of an average container was about $3,000 to $5,000. Now it has skyrocketed to about $8,000 to $10,000. So we're seeing a double in the cost of shipping containers here just within the last year. In addition to everything else that has happened, China had very bad weather in the last month or two in the South China Sea, and that caused delays in shipping. Because of that, we're facing a backlog of shipping. Again, that is causing prices to surge as well. We are actually seeing record demand. I should say record shipment, because remember, just a couple of days ago, I recorded how shipping is actually accelerating. So the cost of U.S. imports, exports, everything is accelerating. So we're in a strong shipping environment, and then we have these types of pressures coming into it. So we are going to be facing a lot of, maybe a lot is an exaggeration, but there's definitely going to be a powerful inflationary pressure that's for anything that is imported or exported domestically or internationally. We don't yet know the results of this because this is just the beginning of it. This is predicted to really start seeing the results in June and then probably July, August. So this is probably going to be a third quarter issue, but this is something I would price into your estimates of what's coming into the economy in the next few months. This is definitely going to affect it. And some people are even talking about supply disruptions nearly that of COVID levels, where we have deficiencies in certain products and major back orders. In our business, we've never really recovered from back orders after COVID. It's kind of just the environment we just sort of deal with from time to time. Now, our back orders thankfully aren't as bad as COVID, but they can be a couple weeks, sometimes even a month, and that was never a pre-COVID issue. And so with this happening, I would say if you are a manufacturer like we are probably going to be stocking up on certain supplies, certain materials, because we don't want to see those backlogs in ordering. We don't want to see any issues with, costs flying through the roof because the supply chain is crunched and inflation is entering the market again. So this is just something to consider. If you're a manufacturer like we are, I would recommend stocking up on certain supplies because the cost of things and the speed at which you get them is probably going to accelerate. And this is going to be a powerful inflationary pressure within the market. So this is, again, why I say there won't be rate cuts this year. And I think the probability of a rate increase is growing by the day. I would say that within the next year, I think we could see an increase in rates. I honestly do, because at this point, everything that Fed has talked about, everything we're seeing in the market, I think I would anticipate at least a quarter basis point to half a basis point increase within the next calendar year, especially depending on what happens with the election. So I don't get too political, and I don't think this is a political stance, but I think a lot of people are holding their breath, waiting for what happens with the outcome of the election. And I think post-election is going to determine a lot of what happens with the economy. It is no secret that many business owners are on the right. And so I think a lot are withholding major moves within the market simply because they're waiting to see if Donald Trump enters the market. If he does, then you could see major swings. There was a Trump rally after he was elected the first time. But even if he doesn't, I think within 6 months, most business leaders are going to be like, well, look, we thought he was going to win. He hasn't. Let's make the moves we need to make. Because a lot of people have this illusion that if Donald Trump comes to the office, all of a sudden the market will drastically improve. Whether that is true or not, that's a public sentiment, especially within the business sector. So I think post-election, we're going to see major changes, and I think we're going to see a powerful swing into an environment that will warrant an interest rate hike. So I would say probably I don't think we're going to get major change this year, but I think by second or third quarter of next year, we're going to be seeing a raise in interest rates. I think it's inevitable. I may be in the minority, but I'm making that prediction now because I believe that's going to happen. And I was right on my predictions earlier this year on what would happen with the interest rate environment currently. I said there was not going to be any rate cuts in 2024. The environment just isn't there, and you could see it clearly in the data early on. Nobody wanted to look at the data. Everybody wanted to look at what Wall Street was saying in public sentiment. They were going off of what they wanted to see rather than what was actually there. So just take that into consideration. I haven't been wrong about interest rates yet. That's pretty much it. So that's my post for the day. It is Friday, so I won't see you guys till Monday. Next week is going to be a little weird. I will probably have videos on Monday and Tuesday. However, Wednesday, Thursday, Friday, I may not, or if I do, I may have it from my office. So I have my in-laws, not yet in-laws because I just recently got engaged, but soon to be in-laws coming into town for a big engagement party. And so they'll be staying with us. And so I'm kind of loud in the mornings, as my fiance often tells me. So I'm going to be really quiet and not do the video here. So you may see me do it from my office at work. I hope you guys have a productive day and a fantastic weekend. I will see you guys next week.